we're breaking it down with the special master of executive compensation for this country, Kenneth Feinberg. You may know him as the U.S. pay czar. And Mr. Feinberg, we welcome you. Thank you so much for making a little bit of a time for us. If you don't mind, I'd like to walk you through a little bit of their money as a business by creating risk for themselves, which we encourage them to do because we want them to risk money, lending it, investing it into our economy so people can build businesses. And in exchange for the risk that they take, they collect money. So the banks have all the money and all the risk. Is that on track so far with my example? This was taken from the banks and given to the government. How do you then make a decision as to how much of the money should remain with the bankers when the risks that the bankers created are now in the hands of the American taxpayer and future generations of Americans?
First of all, Congress spoke to this, not me. Congress made it very, very clear that only those companies that received the most TARP assistance was subject to my pay determinations. And the day that those banks, those companies repay the taxpayer, they are out from under my jurisdiction.
So can we talk about that for a second?
You use examples. Citigroup and Bank of America repaid $85 billion to the taxpayer. They are no longer subject to my jurisdiction. So that's some money coming back in. So can we stop there for 1 second and just talk about that? So your point is Congress said this to Mr. Feinberg, you're only authorized to exert your authority over banks that still have TARP money. That's correct. Do I understand that correctly? Correct. So what confuses me about that, and I'm sure you understand this, there are so many other plans that are still actively being utilized to support the financial system by the taxpayer. And it gets you to something like $24 trillion in support. Not that we're not going to get some of that money back. Obviously, we'll get a lot of that money back, but that money is being deployed to support the system. Now,
why is it that your authority, sir, only applies to banks that received TARP, which only represents 2% of the total state support being supplied to the banks?
Two answers. First, ask Congress that question. I can only do what I do under the law that was enacted by Congress that circumscribes my ability to deal with anything else. Secondly, do not forget all of the other initiatives currently being considered by Congress. Corporate governance reform, regulatory reform, the G20 principles advanced by the Secretary of the Treasury, the SEC's transparency rules.
Understood.
All of that, if you look at the whole menu, that is a much broader attempt to deal with some of those broader problems.
Do the voters, does the press, do American consumers have to do to enable you to have a broader authority over our money? Because if Congress is saying you only get to deal with the banks that are using 2% of the support, but the other banks that are using the 98% of the support, and I go back to your example, Citigroup and Bank of America, those banks are able to pay back the TARP money because they are receiving subsidies from the Federal Reserve that allow them to make money free of charge by getting free loans from the Fed and buying Treasury bonds. So how are they really paying back the TARP money when they're using a government subsidy to come up with the money to pay back the TARP so they don't have to report to you?
That question that you're posing really has to be directed at Congress. I do not have the authority, nor should I have the authority, I might add, nor should I have the authority to micromanage these companies. How you deal with the broader systemic problem of executive comp, which is somehow freed from risk-taking, is really a $64 question.
Are you prepared, and do you have the authority to go in and claw back the executive compensation, specifically of the CEOs, who are the ones who make the decision to take more risk?
I have the authority under the law to examine whether or not a clawback should be implemented. However, it's pretty clear under the law that if the compensation that was granted is based on a valid contract, it was approved by the shareholders, it has the sanctity of law, my ability to sort of act as a super czar or something, which is a very unfortunate term, is limited.
Understood.
And again, I think at the end of the day, almost all of your concern is better directed at the Congress. The efforts by this administration working with the Hill, Congressman Frank and Senator Dodd and others.
And I have, by the way. You say private companies, all those valid contracts. how is it that those contracts remain valid in the context of the extraordinary government intervention that was applied, not just with the TARP, but with all the other government programs that are facilitating it? How come those contracts remain valid in that context, particularly when you look at the treatment of contract law with somebody like General Motors, who had a similar situation in that they were under extreme financial duress. The government made a decision that intervention was appropriate for the prevention of further deterioration in our economy. So we broke contract law with the automakers, but for some reason, when we see a CEO with a few $100 million or $500 million in compensation coming into the bank, while they turn out they can't handle the risk, AIG, whoever it may be, they stick the risk with Uncle Sam and they keep the money, and we claim contract law? Really?
Be careful. Big difference between automobile companies having contracts voided as a result of a formal bankruptcy filing.
Understood.
Where there's a reorganization plan and a consensual effort. And with some of these banks or some of these other issues, we have valid contracts which are protected by the Constitution. You have to be careful about how you challenge those.
I get that, but at the same time, what enables a financial institution to take excessive risk, arrive in Washington, D.C. at the Treasury on a weekend and say, I need, I don't know, $85 billion for AIG. Where's the contract there? Where's the Constitution?
There are some powers under the law that I do have to challenge those, take a look at them, see where, even under my narrower jurisdiction, I should exercise some discretion in considering doing that. But be very, very careful about making distinctions between companies that file for bankruptcy and have contracts restructured.
Understood.
And banks and other institutions that remain in business.
But banks they remain in business only for the largesse of the U.S. taxpayer and an arbitrary policy decision made by the U.S. government in the Congress, and we'll go back and forth for days. It's a real pleasure to see you, and I do appreciate you making the time to talk to me.
Thank you very much.
You can stay for 1 second here. At this point, you're, of course, probably wondering what we can do to stop this risk-reward cycle, to stop the big bank CEOs from keeping all the profits of their legalized, which is Mr. Feinberg's point, gambling, and then pass the risk on to you, our government, and in the process, suck trillions out. You heard Governor Strickland at Ohio earlier. They don't have any jobs. There's no small business lending, but the money's rolling here in New York. Well, in my opinion, there are three people we need to hold accountable. The first is the Fed Chairman, Ben Bernanke. The second, the Treasury Secretary, Tim Geithner. And the third, the White House National Economic Council Director, Larry Summers. These three men created and even enable, in my view, a system that is still in play today. Mr. Bernanke, if you will, is your arsonist fireman. Yeah. And yes, it was clearly Mr. Bernanke who put out the flames of the financial collapse by offering an infinite supply of money from the Federal Reserve to the largest banks in America in February of 2009. After months of programs and catharsis, finally Bernanke said, listen, infinity, and calm down. The fire he put out was one his policies helped to start, in my view, by handing out those cheap loans from the Federal Reserve to the banks for years where they're able to gamble again by levering it up. Today, in fact, the Huffington Post reports more senators in our Congress are hedging on whether they'll even vote to reconfirm Bernanke because of their concerns about his role as arsonist fireman. In fact, news just coming through over the past half hour that Senate Majority Leader Harry Reid now has asked Republican leader Mitch McConnell to see how many votes he has on the Republican side that are for Bernanke. Meantime, three more senators, Russ Feingold, Barbara Boxer, and Byron Dorgan, added their names to those in opposition to Mr. Bernanke, whose term is officially up at the end of this month. Then there's the Treasury Secretary, Tim Geithner, who remains the keeper of secrets. Again, he is the one with the authority over the AIG emails and the provider of backdoor bailouts. Again, those documents and the 100 cents on a dollar pass-through from AIG into the shadow banking system, Goldman, Morgan, now Barron Lehman. Under fresh scrutiny for his role in the New York Fed's decision to funnel billions through AIG and big banks and his ongoing refusal to disclose that email trail, which could show why the Fed had to do it. And the last in the trifecta is a man that I like to call the high priest of financial deregulation, Larry Summers. He was Treasury Secretary under President Clinton, and Summers, one of the key architects of the bank rule changes, incentivizing the excessive risk-taking that Mr. Stiglitz was talking about in his testimony earlier today. Those policies continue unchecked and with unlimited state support to this day, despite a various list of proposals Mr. Feinberg just referenced to alter it. In my view, the buck stops with these three men. And it is so good to know this week that voices like Chairman Paul Volcker and Professor Elizabeth Warren, who understand the structural flaws in a system that takes other people's money and gambles with it, that allows uncollateralized insurance to come into the marketplace and allow willy-nilly lending and gambling. Now, maybe it's time for some of the old voices to go in order to give the new voices, like Warren and Volcker, a chair.